Hi dear traders, the previous trading week was shorter than usual due to Thanksgiving Day celebration in the US. Amid muted sentiment in the market, investors preferred not to make any major moves. Market participants mainly observed the situation and drew their own conclusions, particularly regarding the Federal Reserve's next steps. Fed policymakers have seen arguments for a slower pace of interest rate hikes and admitted that recession risks are on the rise. US indices increased by more than 1% at the end of the week, boosted by the focus on the Fed's dovish band. However, the NASDAQ lagged behind other indices and lost about 0.5% on Friday. Shares of Activision Blizzard declined by more than 4% following reports that the US Federal Trade Commission plans to file an antitrust lawsuit to stop Microsoft's acquisition of the video game publisher. In other corporate news, Apple iPhone production at the Foxconn plant in Shenzhou, China may drop by at least 30% due to protests. Factory workers have protested against quarantine measures disrupting production at Apple's manufacturing facilities. On Monday, Wall Street moved into negative territory as markets lost support from macroeconomic data. Amid uncertainty about the future, reports of lower than expected Black Friday sales in the US intensified the bearish sentiment of market participants. Watch our video review and leave your comments down below. This week, investors will focus on a number of data releases, with the key one being the monthly US non-farm payroll report. It would be followed by remarks by several Fed policymakers. Other reports this week are the US consumer spending data, the ISM manufacturing PMI, and the second GDP estimate. Investors will also pay attention to earnings reports by several major companies such as Salesforce, Intuit, Dollar General, Workday, and CrowdStrike. Market participants remain anxious about high inflation and the risk of a recession in 2023. The main risk facing the economy is inflation becoming entrenched. The regulator's target inflation rate of 2% is hard to reach at this point. If GDP, unemployment, and consumer demand decline, the US central bank will be forced to reduce interest rates. This will delay achieving price stability once again. Expectations of a recession within the next several months are forcing investors to assess the possible decline and its potential impact on the stock market. However, Wall Street is showing signs of recovery, which gives hope that the bear market could be coming to an end. However, not all investors are hopeful. Some expect equities to drop once again and believe the rally of the last few weeks is a bull trap. Historically, bear markets during a recession often ended in a capitulation. It's expected to occur next year and could allow investors to estimate when the trend reversal will begin. However, the recent equities rally suggests that investors believe the market has already bottomed out. For example, the S&P 500 hit its low of 3,491 on October 13. Last week, stock markets were quite optimistic. On Tuesday, S&P 500 closed at its highest level in more than 2.5 months. The index gained 1.5% over the week, although this result was rather moderate. The current bear market resembles a downturn that was observed in 2002 and differs from the events that took place in 2008 and 2020. So we can forecast that the downtrend will continue. The current downturn was preceded by a bull market which resembles the situation in the late 1990s, when retail investors' participation was high. According to BNP Paribas, many successful corporations were unprofitable back then and had speculative intentions. When we look at recessions of the past 100 years, the year 2002 was remarkable in this sense. In times of a recession, the period of the bear market can be rather long. On average, it lasts for 1.5 years, but in 2002 it lasted for 2 years. The declines tend to be deep, with an average drop of 40%. However, in 2002, the stock market tumbled by 50%. Moreover, the pace of decline is usually slower than during non-crisis periods. Given the average data, we can predict another drawdown in the market in the middle of next year. If so, the S&P may hit the bottom at 3,000. Technical indicators confirm that the index is sliding down. Just like a week ago, the bulls on the instrument are fighting for the level of 4,000, but they are unlikely to succeed. The S&P 500, the broad-based market index, is expected to trade in the wide range between 3,500 and 4,000. The justified value of the index is believed to be the level of 3,650. If we consider the weekly chart, the first thing we notice is the trading volume. It has considerably declined, yet the price managed to move slightly above the local high. In just 1.5 months, the S&P has gained 13%, while the NASDAQ 100 tech index has risen by 22% without any pullbacks. So it might be time for a slowdown. After such a long advance, the indices are likely to enter a short correction, especially given the upcoming macroeconomic data. Besides, the Fed meeting is coming on December 14, as well as the inflation data a day earlier. The Dow Jones jumped by 1.7% over the week, adding more than 150 points in shortened trading on Friday. On Monday, following the trajectory of other indices, the Dow Jones entered negative territory. The instrument lost more than 300 points, while S&P and the NASDAQ dropped by more than 1% each. Worries about the prospects of a global recession are growing. Widespread protests against strict COVID restrictions in China exaggerated concerns about the health of the world's second-largest economy, while sending shock waves through global equities markets. On Monday, market participants paid close attention to the statements made by Fed officials. Thus, James Bullard said that markets might be underestimating the chances of more rate hikes. John Williams echoed his words, saying that a lot still needs to be done to curb inflation. Nevertheless, the focus of investors will most likely be on Fed Chair Jerome Powell's speech to be delivered on Wednesday. He is expected to comment on the economic outlook, inflation, and the labor market. This may well dampen risk sentiment. Given CPI data released in November, it can be assumed that U.S. inflation will show signs of cooling. However, it is still unclear what the message of Powell will be. Financial markets placed a 70% probability of a 50 basis point rate hike in December. At the same time, growing unrest over China's stringent COVID restrictions heightened fears of weak economic growth. The dynamic of the NASDAQ 100 was the most sluggish last week compared to other key indices. It added only 0.7%. The index suffered heavy losses on Monday, thus trimming gains posted amid its confident recovery throughout November. Much will depend on Powell's speech this week. The head of the Fed is likely to signal that he sticks to its aggressive policy stance. There are also concerns that Powell may deny reports that the regulator will continue its relentless efforts to bring inflation back to the target, even if the economy and the labor market show clear signs of a slowdown. It's doubly dangerous if his speech is accompanied by downbeat economic statistics. The labor market report will act as a gauge of U.S. economic activity. The corporate news is neutral. Apple's stock fell over 2% on Monday following reports that the company could face further production cuts due to unrest at the world's biggest iPhone factory in China. Protests in major Chinese cities against strict zero-COVID curbs hit growth expectations in the world's second-largest economy. If the situation remains unchanged, it could lead to supply chain disruptions. Thus, investors have a lot to think about. Unrest could result in a production shortfall of up to 6 million iPhone 14 Pro units this year. The Foxconn facility reportedly produces the vast majority of iPhone 14 Pro and Pro Max devices, Apple's most demanded iPhones. These models help the company offset a drop in demand for iPhone 14 units. The situation is unstable, so production losses may even be more tangible. If the Chinese authorities do not ease lockdown measures in the coming weeks, production may further delayed for an indeterminate period. The Shenzhou campus has been racked by lockdowns and worker unrest for weeks. Thousands of staff fled in October after chronic food shortages, only to be replaced by new employees who rebelled against pay and quarantine practices. Although the troubles of Apple and China affected the market, Amazon helped limit Wall Street losses. The company said it rang up record-breaking sales on Cyber Monday. Shares of the e-commerce giant advanced by 2% following an industry report that spending on Cyber Monday, the biggest U.S. online shopping day, might hit a record $11.6 billion. And we continue to monitor the situation in order to keep you up to date with the latest market developments. Subscribe to our channel and comment on the video. That's all for now, and see you soon.